Brad, tell us a little bit about the Capital Solutions and your role there.
Capital Solutions is a debt advisory firm primarily focused on sponsor-backed companies in the middle market and the lower middle market. We provide debt capital raising services as well as restructuring advisory services. Most of our deals tend to be in the $30 to $50 million credit facility size, although we've done a few in excess of $100 million.
And Brad, obviously the economy seems to be bouncing back, and the light at the end of the tunnel is there with the pandemic. What's that mean right now in terms of conditions in the leveraged lending markets?
The leverage lending market, specifically for sponsor-backed transactions, is just as robust as it was pre-pandemic. What's really driving this is the fact that both sponsors and lenders alike came into the pandemic with a lot of dry powder. And both groups have really been adding to the dry powder with incremental fundraising over the past 6 months. What happened in the late summer, early fall timeframe is, as both the sponsors and lenders realized that this dry powder, as well as significant deal team time and resources, was not going to need to be invested inwardly into the portfolio as most had expected, the door swung wide open again for new M&A deals. With the leverage levels today, I would say are certainly this is for a garden variety middle market company. It's certainly at least 6 times, potentially a little north of 6 times. And for loan pricing, I would say that's in the L4 handle to L5 handle area.
Brad, what's a recent example of a trend that you're seeing among your clients, among the sponsors, that's surprising or that you haven't witnessed before?
You have lenders all really trying to chase basically the same thing, which are really the highest quality companies out there, which would be defined as recession resistant or even growing, as evidenced by performance over the last 12 months during the pandemic. Before, because we had such a deep and prolonged cycle, the prior recession was, call it 6, 7, 8, 9, up to 9, almost 10 years prior to that. So, a lot of companies, it was really hard to demonstrate how they would perform during the pandemic. Now, what we're seeing is you have that instant data point, and there's an instant sort of flight to quality, if you will, of flocking to those companies that have performed quite well during this pandemic.
Why do some top quartile firms still have poor track records?
I'd love to give you a stupid guess, but I can't even really think of one.
Well, they're top quartile of the bottom quartile.
Ah, all right. Okay.